Now, coming up now, we're going to cross to our CBD studio, and Roger Montgomery is there. And Roger, of course, is the CIO of Montgomery Investment Management. And he's going to give us a good idea about some growth stocks that are out there right now that we should be looking at. Roger, thanks for joining us.
Oh, Peter, it's always great to be on the program. I'm sorry I couldn't be with you. I was at the Morgan Stanley spring function at Cafe Sydney, and so it was very important that I attended that function. I couldn't be in two places at once, so sorry I couldn't be with you in person.
Not at all, mate. I hope they gave you some new insights that you can share with my audience.
I plan on doing precisely that tonight.
Okay, mate. Well, I have billed you as that. You know, you're the kind of guy that goes looking for stocks on steroids all the time. What do you think's going on in the market generally right now?
So I'm going to repeat what I've said to your viewers, Peter, over the last 6 months, and that is that what's happened is everyone's gravitated towards what they believe to be the lowest risk stocks, large caps and infrastructure and utility companies. But by doing so, what in fact's happened is they've gravitated towards the riskier stocks. So what we've seen in the ASX 200, just by way of example, is that since 2010, the payout ratio of the ASX 200 has risen from 55% to 80%. Now, what that means is that where there previously was 45% of profits being reinvested for future growth, there's now only 20% of profit being reinvested for future growth. So that's a fact, and that means, and obviously what's happened is company boards have acquiesced to shareholder demands for more income. So investors who aren't getting enough interest on their term deposits have moved into shares. They've gone into what they believe are the safest companies, the Telstras, for example, and the banks, and they've then demanded from the boards a higher payout ratio. At the same time, because the yield curve is completely flat, there's no incentive for companies to reinvest for the long term because they can get the same rate of return over the short term as over 30 years. Therefore, why would you take the risk of investing over 30 years? So they don't. So boards acquiesce to the shareholder demands for more income, and the payout ratio has gone up. But the problem is that they are some of the most expensive stocks on the market today. Everything that's deemed safe with a reliable income stream, Telstra, for example, is seen as safe, and so it's really expensive. And the other category of companies that are really expensive are the utility companies and the infrastructure stocks. And the reason they're expensive is because when we as professional fund managers are valuing a company, the value of a company is simply the present value of its future cash flows. How do we calculate the present value? Well, in the simplest terms, it's future value divided by 1 plus the interest rate to the power of the number of years. And if the interest rate goes down, well, the product of the formula goes up. And so when you've got a company, so that's your present value calculation, and we use something called a weighted average cost of capital, which is a combination of the cost of debt and the cost of equity. And because infrastructure stocks are mostly debt, and for example, Transurban, Sydney Airports, you're talking about companies that are 100% debt funded, and they've got negative equity, then what actually happens is that you're using just the interest rate to discount the value, the future cash flows of that business. So as interest rates fall, obviously what happens is the valuation of that company rises, and as a result, you've got very expensive valuations for companies that either have no growth because they're paying out all their earnings as a dividend, or they've got a lot of debt. Now that's a corruption of the assessment of risk that happens when interest rates are so low. So I'm only repeating what we've talked about now for 6 months or so, and I think that we're getting to a point where, while I was away on holidays for school holidays, I noticed that the 10-year US Treasury bond rate went from 1.36% to about 1.76%. So that's a 0.4% move, almost 0.5% move in long bond rates. And everyone's sitting around waiting for central banks to raise rates before they head for the hills. But I actually think even if central banks don't move rates, if the long bond rate goes up, and arguably it doesn't deserve to be where it is, it's lower than where it was during the Great Depression, and we don't have 70% unemployment, that tells me that eventually this is going to end and interest rates at the long end will go up, we'll get a steepening of the yield curve, and the valuation of assets will drop. And Peter, that's my big concern, and that's why we're holding over 30% cash in our long-only funds. That's why we've launched a long-short fund, because we believe there's money to be made on the short side.
So you're anticipating that the market, the stock market, over the next 12 months is going to go through some challenging times?
Look, I don't know the timing, but really investors are being really silly if they try and get their timing exactly right. In the long run, it makes no sense to have cash because you are much better off owning a business at almost any price that generates a 20 or 30% return on equity than you are having your money in a bank which earns a 2% return on equity. So you're better off owning a business than you are putting money in the bank. But what cash does is it gives you optionality, and it's an option over lower prices. And I think at some point in the next 24 months, I'm going to take a guess there, we are going to see lower prices of assets right around the world, and that's property, that's private equity, that's listed equity. We're going to see lower prices. And some cash, while it's only earning 2%, it's a darn sight better than minus 20%. So I don't know the timing, and it might be that by having 33% cash at the moment, we're going to miss out on a rally in stocks. But I can't find a lot of value at the moment, and I've been telling you that now for more than 12 months. And I think now we're getting to the pointy end where interest rates at the long end start to rise and present values start to decline.
But Roger, historically, when interest rates start to rise, there's usually a period, correct me if you think I'm wrong, but there's usually a period where the stock market can rise.
Yeah, it does well.
Yeah, and eventually the interest rates get high enough and people say, well, why should I take a risk in a stock? So what actually happens, Peter, is the first 2 or 3 interest rate rises from a central bank is usually seen as a very positive thing because it means the economy is recovering and profits are rising. So the stock market tends to do well for the first 2 or 3 interest rate rises by a central bank. But after that, then everyone realises, hang on a sec, I can get a better return with less risk by being in cash or in term deposits, and so the market then heads south. But just remember, I'm not particularly interested in whether central banks raise rates or lower rates. What I'm interested in is whether the long bond rate starts to go up, because that's the rate that businesses decide on whether or not they're going to invest in a project, and that's the rate that investors use to determine the present value of an equity security, which is a piece of a business which has very long duration. Okay, given all that, warning that you've put out there, is there a company or two that you like at the moment because they look like they've got potential?
Yeah, look, and I'm going to mention the same sorts of companies that I've talked about before. The first one is Challenger. Challenger will, its share price, if my scenario is right and long bond rates continue to rise, then Challenger will suffer, its share price will suffer because people will mark to market its liabilities and assets, and it will suffer on that. But it will sell more annuities because they suddenly become more attractive because it can asset match, or if you like, it can asset and liability match, and it will offer products with a higher return. So they'll sell more product and they'll make more money. So that's the first one. So counterintuitively, the market will price them down, but at the same time the market's pricing them down, they're more valuable. And the other one is REA. I think the property market is overvalued in Australia massively. I think we're seeing people geared to the eyeballs, and that's all going to end in tears. And that's going to have a negative effect on sentiment towards REA, but they'll actually make more money in a market that's not a boom market, because in a boom property market, REA, what happens is less properties are advertised, so REA makes less money.
Okay.
In a mature property market, they make more money.
All right, buddy, we're out of time. Thanks for that, Roger.
Pleasure.
Roger Montgomery.